Many of you enjoy my quality stocks videos, and I have a very exciting one for today, trading at fair value. Now, the last one was a huge success, which I talked about it 8 days ago, titled The Cheapest Quality Stock in the Stock Market. And this one was Evolution Gaming. And today the stock is up 15% after reporting earnings, and earnings were very good. They bought back a lot of stock, but I don't think anyone is late to the party. I think the rally is only getting started. It has a long way up to go. The stock is still very cheap. They bought back a lot of stock. Amazing company. This one isn't as cheap as Evolution Gaming stock, but it's a high quality company with a wide moat, durable competitive advantage, you could say, and just a good company in general that I believe could return 15% a year over the next 5, 6, 7 years, or double every 5 years, which would be an amazing return. I'm going to share all the details here in this video. As always, I would appreciate it very much if you could press the like button or maybe dislike, or just let me know what you think. If you agree with me, disagree with me, let me know what you think in the comments. Okay, now the stock is CP, which is Canadian Pacific Kansas City. The stock is down 9% on the month. It was doing pretty well and it went up to $87, $88. Now it's back at 78, and this has been a trend over the last 5 years. The stock goes up and it goes down. It's up like 6% over the last 3 years. It has really underperformed, and it just goes up and it goes down. It's very predictable, but it's eventually gonna break out of this cycle and it's gonna go much, much higher once it does. And maybe this date is coming up very, very soon, and I believe it is, and I'm gonna tell you why and give you everything in the video. And I recently reported earnings. It wasn't the best report ever, but it was a slight miss, like a 1.2%, nothing too crazy. And the stock sold off even more on this day. But CP, which is Canadian Pacific Kansas City, is a merger between Canadian Pacific and Kansas City Railway. They merged together. I believe it happened 2 years ago or 2.5 years ago. And they created something very special, which, if you could correct me if I'm wrong, but I believe it's the only railroad network that connects Canada, United States, and Mexico together. Three-country connectivity all within one network. This is pretty massive. This is pretty amazing. And this is what gives this company its competitive advantage. Most, railroad stocks, they do have some kind of a moat or a competitive advantage, mainly because of the network. It cannot be rebuilt. Buffett likes them very much. That's why he bought BNSF before. And he likes railroads. It's an old school business that's not going anywhere anytime soon. And it's going to be here 10, 20, 30, 40 years from now. And these companies are amazing companies in general, but especially CP, because they connect all those three countries together within one railroad network. And this is very important because in terms of, total US imports, China is no longer the largest trading partner of the United States. Now Mexico is the largest trading partner of the United States, and you have CP, which connects Mexico to the United States and Canada all together. And they're seeing a lot of volume increases in the automotives and many different things that are being built in Mexico, and they're importing them in the United States. And I don't believe this trend is gonna stop anytime soon. I think the China-US relations have peaked, and it's shifting. It's shifting to India, it's shifting to Mexico. And you have CP that's a way to bet on it and to bet on a lot of reshoring stuff and a lot of different things. And CP is an amazing way to bet on it. And that's another catalyst for the stock, or you could say a long-term tailwind. Something else that's very important with those railroad stocks is the frequency of, you could say, train accidents. Because a lot of you know what happened with Norfolk Southern and what happened in Ohio and all these things. It's terrible. And they could be sued for billions and billions of dollars. But in terms of CP, they do have a track record in terms of train accidents. As you could see on the red line, it's pretty much the lowest. The highest, is Norfolk Southern, and I believe CSX and UMP, they're the three highest. And then you have CP, it's the lowest. And this is something very important to know. A lot of you have been asking me, and a lot of people, why has the stock been flat over the last 3 years? Like, it's just crazy. Like, what is it gonna cause the stock to eventually go up? And there's two reasons. The first one was the merger. Whenever you have a merger, you're gonna have a lot of uncertainty. The stock gonna be going up and down. So they were going through the merger, This is one reason. But the second reason and the biggest problem with CP, because it's an amazing company, they have a moat, they have a railroad networks, they have tailwinds of the US relations with Mexico instead of China. They have so many different tailwinds and so many different good things. But the worst part about CP is the valuation. And the valuation has been very high for way too long, and it's been getting priced in the company. The company has been growing into its overvaluation, and this is the main reason why the stock has been flat over the last 3 years. And even though the stock is down like 9% on the month, it's still trading at 22 times earnings. Now, looking at the mean is 22 times, but it traded as low as like 14, 15 times, and now sitting at 22 times. So even though the stock has been flat for a while, and it's down like 8% on the month, it's still nowhere close to being undervalued, maybe fairly valued at its best. And this is maybe for good reasons, mainly because of the network, because of margins, because of higher growth expected, but it's still not a cheap stock, and it has to price in a little bit more. It has to grow into the overvaluation before the stock starts moving up in a sustainable way, in my opinion, especially if you compare it to other railroads. And this is a glitch from Ticker, but you could read them over here. CP is trading at 22 times earnings. UNP, which is another high quality railroad company, is trading at 20 times earnings. You have CNR, Canadian National Railway, is trading at 19 times. And then you have Norfolk Southern, is trading at 19 times. So CP is definitely trading at a premium. I believe it's the most expensive railroad company between the United States and Canada. Is the most expensive one, but it also has the best tailwinds, the best growth prospects, and I believe the highest earnings per share growth estimate over the next 5 years, and a lot of synergies between those two mergers that happened not long ago. So there's a lot of things to be excited about, but the stock is still expensive. And even though here 22 times isn't too bad, I would personally like it around 20 times, 19, 20 times would be ideal for CP. And it's likely gonna take, in my opinion, another 6, 8, maybe 10 months for the company to grow into its valuation, to trade at a fair multiple, so I could have a longer term sustainable move. Now, if we look at the last one, it wasn't too bad, but they did grow like 6% in revenues, and 6% revenue growth. It's not enough to justify 22 times earnings. I'm just being honest. And that's why I believe the company has to trade a little bit lower. But in terms of their own guidance, they are guiding earnings per share growth double digits. So double digits adjusted combined EPS growth, and double digits meaning above 10%. Now, the analysts, they have around 17%, 14, 16, 13. So average around 14 to 15% per year on average of earnings per share growth. Now, if the company does grow 14 to 15% earnings per share, which I believe is highly achievable for this company, if they do that and they still trade at 22 times earnings, which is the mean multiple, I would expect the return of the stock to mirror the growth of earnings per share, meaning I would expect CP to return 14 to 15% per year over the next 5 years. And this is assuming no multiple expansion and no multiple contraction. But if you do have a multiple contraction, and if CP does not deliver on those results, then there's a lot of room for downside, and it could go much, much lower, and it might not return 14 to 15%, which is why I would prefer to buy CP around 20 times earnings. If I'm buying it at 20 times earnings, I have the potential of a multiple expansion from 20 to 22 times. So I have some kind of margin of safety, some kind of downside protection, and then I could have some upside in terms of earnings per share growth and everything. In terms of 20 times earnings, that would be around $68 to $70 per share. So if it trades around $68, $69 per share, that would be around 20 times earnings. And I would like the stock very, very much. But even here, if everything goes well, I would expect 14 to 15% a year, which is around a double every 5 years, with an amazing company like CP that I believe is very, very safe. And I believe it's not going anywhere. And I like it very much. And that was my pick for today in terms of a quality stock trading at fair value. It wasn't financial advice. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.